welcome to this session and to our presentation on the issue of whether bank credit can help farmers mitigate nature and climate change risks in cereal production. So, to begin with, cereals, that is maize, wheat, barley, sorghum, are consumed predominantly by households in Kenya. So the production of these cereals, well, has been more or less the same for quite some time. From the data that we have from 1963, the yields per acre is about 1.07 ton per acre. But in per capita terms, the cereals available per head has declined from about 170 kgs to about 65 kgs annually per individual. So which means, for example, me, if I was there in 1963, I would have consumed 170 kgs. But today, I only consume 65 kgs per year. So, and we understand that production and consumption as well as income go together. So that means that the incomes that are derived from cereal production per capita wise has been declining. Yet our population is rural, it depends on the cereal and so forth. So this decline in cereal production is attributable to climate change, environmental degradation, and as a result, for us to stem this decline in cereal production, farmers have tried to use smart agricultural production to enhance productivity. We know that the available arable land under cereal cultivation is finite. We can only deal with productivity issues. So one of the ways in which productivity can be enhanced is first to counteract the adverse effects of climate change and nature. Nature by reducing soil erosion and increasing soil productivity by utilizing fertilizer or adopting farm practices that increase soil fertility. So, these interventions to increase productivity among cereal producers or cereal farmers is either implementing good practices that are sustainable or buying farm inputs and adopting more qualified skilled labor to increase cereal production and also reducing post-harvest losses. But these interventions are costly. They are beyond the incomes of farmers, and savings are very low for a typical farmer. So how does the financial sector come in to counteract this? The banking sector can counteract this decline in cereal production per capita by providing credit, what we call agricultural credit. So agricultural credit is essential in financing inputs, enabling farmers to access modern technology and counteracting the effects of climate change. For example, installing the irrigation system or buying pesticides that are used to control a pest, for example, the locust. But even with this, access to bank credit by farmers, especially those who are susceptible to climate change, is very low. So, which means that even if they were to access it, one of the things is very low. Secondly, the existing empirical evidence is not clear on whether climate change actually is the factor that is reducing cereal production. For example, for the case of rice, if there is flooding, it's good for rice production, right? Because rice thrives in paddy fields. if it is drought for an extended period of time, it enhances nitrogen fixation. For those who could remember biology, nitrogen fixation is where nitrogen from the atmosphere is fixed in the soil, so to speak, and nitrogen is essential for cereal production. But we know that in the interim, in the short run, if there is drought, it interferes with the physiological processes that will lead to a premature drying or even reduce the yields. So these are the two things that motivated us to analyze the issue of how bank credit can help. At the same time, even if farmers could access this bank credit, some of them could employ practices that are not sustainable. For example, deep cultivation that disturbs the soils too much, such that it reduces cereal production. So, on balance, existing empirical evidence does not tell us clearly whether bank credit can counteract climate change and therefore increase cereal production. So, that's why we set out to answer two main questions. First is, what is the role of bank credit in enabling farmers increase productivity? And secondly, does it help farmers to counteract the impacts of climate change so that they can enhance cereal production, so that the cereal as a crop contributes meaningfully to the nutritive content for households, and secondly, to enhance or to increase incomes for households that depend on it. As we know that about 30%, about 20% of GDP is agriculture. Out of it, about 7 to 8% is for cereal cultivation. So if we can have a meaningful way in which access to credit by farmers can counteract these impacts of climate change and enhance productivity in cereal production, and to increase the yields as well as the incomes, and also reduce the adverse impacts of climate change on households, then that will be very good. So, this is very important in terms of the existing empirical literature which we have had, is that first we have to approach this issue, that main question, this way. First, there is climate change impacts that undoubtedly have an effect on cereal production. So there is evidence that climate change impacts cereal production negatively. There are those that impact positively. For example, carbon emissions, plants taking carbon dioxide outside. So if there is, which means by extension that even if there are emissions, it's beneficial for plant growth, right? Then on the other hand, we have drought. In the short term, we know nothing can survive without water. In the long run, we know that after drought, we usually have a bumper harvest because of nitrogen fixation and all these things. Then when it comes to the issue of credit, also the existing empirical evidence is that farmers get money. The credit bridges the financing constraint that farmers face. One, they purchase quality seeds that's qualified seeds. Secondly, they are able to undertake timely farm operations, and that increases production. And fourth is about mechanization. So savings are not sufficient to mechanize agriculture and cereal production, but with credit, it bridges those ones. So as a result, they increase productivity. Finally, there is credit enables farmers to purchase farm inputs like pesticides, fertilizers, which makes crops to grow faster and be resilient to environmental or climatic changes. And that is good according to the existing. So conceptually, we look at it this way. For those who have read, is that so the decision to borrow, if they indeed borrow and there's no adaptation and mitigation, the farmer's income will be affected. But if there is access to credit and enables them to mitigate the climate change, then we see that everything, cereal production will be enhanced, and therefore our socioeconomic outcomes will be okay. And this contributes also to the stability of our financial system because the loan portfolio that goes to agriculture is about 7% as we speak. It's about 7 to 10%, although it started from far much higher. So the question that we ask, that we answer is, first, we start with the point that how does cereal production affected by access to credit? So here we regress. The main variable there is bank credit, actually agricultural credit. Then we control for climate change variables. That is the temperature and rainfall. And then we control for acreage and also mechanization. This is just an ordinary production function where the output is explained by the inputs. And one of the inputs is bank credit. So by construction, we see that there are some variables that have tendency to increase. For example, from 1963, the data that we use to the current data, we realize that there is tendency for temperature to increase. So which means there is climate change. So the variability of rainfall across the months that are used, that are relevant for production, has also increased. So if we use, for example, temperature in levels, there is a time dependency in temperature, and also cereal production has been increasing over time. So we have integrated with order 1 variables and integrated with order 0, especially acreage and mechanization. So which means we have to estimate this based on the ARDL model. So first of the findings is that we control for rainfall, that's precipitation, and temperature in separate equations because they all measure the same thing. So we see that we start with private sector credit from the banking sector. We see that it enhances cereal production. Then, even if we control for example, temperature is negatively correlated with cereal production, and because of interference with the physiological process of plants. And on the right-hand side, we consider agricultural credit in particular, because private sector credit could be going to other places, so that are not pertinent to agriculture production. So we go further into agricultural credit. Well, if there was data, we could go to credit that goes to cereal production. So although there's data, but the series is short. In this case, we see that bank credit to the agriculture sector increases cereal production. So whether we control for temperature or rainfall, so possible channels, and then even if we control for carbon emissions, CO2 emissions, they are negative. So, but of course, acreage, that's the land area, is positively correlated with it. So, well, the conclusion here is that that credit is important, but the approximate way in which credit is affecting cereal production is through enhancing, through purchases of inputs and timely farm operations. For example, paying salaries of workers. So in time. So in this other regression, we do a pan. So we go by crops. So each of these crops, and in our extended results in the paper, they are largely consistent with the results that we obtain using agricultural credit. First is that credit to these sectors enhances cereal production, even if we take it per capita. And the challenges are that timely farm operations, mechanization, and skilled. So even if we control for skilled labor, we control for mechanization, the land area, and the carbon emissions. Still, credit stands out prominently in this. So which means access to credit somehow tries to counteract these impacts, the negative impacts of nature and climate change, to enable farmers produce even more. Related results is that there are some crops, for example, sorghum, that is adversely affected by drought. However, wheat, if it receives moderate rain, that's from the coefficients in our extended results, indicates that sorghum, which thrives in slightly lower amounts of rainfall, does well, and that's why we have, when there is drought, with longer lags, or even in the shorter form, it has a positive coefficient. So we attribute that to the fact that sorghum requires less rainfall, and therefore, if it rains too much, it is adverse to its production. So the conclusion that we draw, from this is that access to bank credit is important to farmers, especially because it helps them to access farm inputs, mechanize, adopt farming practices that counteract effects of climate change. So we see that from the results that if there is drought, output reduces, so which means climate change is affecting yields. Secondly, so given that amount of credit that's channeled to agriculture is started from 12% and now we're about 6 to 7% of the total credit, we need to channel more credit to that sector so that it has the capacity to counteract climate change impacts. So, and that will enhance, will boost cereal production, and at the same time, if farmers are adopting smart methods of production and they're financed to switch into sustainable methods, then the better, because we need to counteract climate change using smart methods of farming. So thank you so much.
I'm happy to be here, and I'd like to take the shortest moment to discuss this paper. First, I want to appreciate the authors, Maureen, Peter, Anne, and Roseline, for coming up with a very timely paper which addresses issues that are relatable to this economy that we are in. Agriculture is the backbone of this country, and in the paper we see that 60% employment is from agriculture. And the other important thing about the area is that agriculture helps in improving balance of payments and also stability in food prices. And it's a climate policy relevant sector, and it contributes to feeding the nation. When I went to read this paper, I found a lot of information on the background, and especially on the variables that are being discussed. The variables, independent variable, being the climate risks, weather-related temperature changes, we have carbon emissions, and we have precipitation, and we have the dependent variable, that is cereal production. So the paper tries to explain how bank credit mitigates the effect of climate risk on cereal production. If you read the paper, you'll find it very interesting, as I did enjoy reading it. So bank credit from the paper helps farmers to get the inputs. And the inputs here, we are looking at the seeds, payment of labor, and also the scale of production in terms of the land and being able to get fertilizers and so on. So the paper provides comparatives when I get into the details of the regions. If you read the paper, you'll find what has been done in Turkey, in other markets like Zambia, Nigeria, and you'll find a lot of information coming in from it. And in the paper, you'll also read challenges that are facing cereal production that have been highlighted. There's declining cereal production that influences inflation, and Dr. Wamalwa has highlighted that from 1963, the bread basket has been going down and the population has been going up. So we need to look at what are these things that can be done, maybe from the credit side, to improve production of cereals in this country, and how do banks come in to help in terms of climate smart agriculture. To improve the paper, I looked at what has been stated in the booklet that you have. The topic is not the same as what you're reading, so don't dwell on that topic. The topic is, does credit mitigate the effect of nature and climate risks on cereal production, which is more focused than what you're seeing in the booklet. And thank you to the authors for changing that. Climate risk is an externality, and therefore, this is an area, the agricultural sector is an area where adaptation to climate change is really necessary, and it should come in, even say yesterday, if we can use that term, so that we can improve the bread basket for this country. And it's important, therefore, for the authors to go deeper and incorporate some adaptation measures that bank credit can propose so that we can improve and find solutions. The paper is rich. It has a broad perspective. In the paper, you're going to read about adverse selection. You're going to read about moral hazard and asymmetric information. So the question about adverse selection, if you look at some of the graphs that are posted, you'll see that credit to this sector has been declining. The question is why? Why would there be adverse selection? What are the mitigations that can be done to improve? What models can be created for this sector to mitigate probability of loss on the credit side? So the issue of moral hazard has also been brought out in the paper. There's the issue of maybe a borrower knowing that their land is not good enough for production, but still in the paper you're going to find that if there are enough inputs provided for through credit, and it can improve production. So the issue of infertile soils was brought out, nitrogen fixation, and so on. So the question is then, what can financial institutions do to pre-screen when they are pre-approving loans in agricultural sector? What can they do to mitigate for the risks that are foreseen in this sector? You see issues of seasonality, crop failure. In this country, we have institutions. We have Met Department. We have institutions that do soil analysis. So can we get this helping the farmers so that there is, all other factors remaining constant, there is promised productivity in the sector? Then what are the mitigants in terms of capacity building when it comes to the actors, the farmers? How would you probably provide a solution so that institutions don't shy away. The issue of financial literacy could come in, the issue of capacity building in terms of operational efficiency, a reduction of revenue leakages, and then what are the specific models for different zones? For example, you say a region like Rift will have different agricultural products, like different from Eastern. So when you're looking at cereal production, can millet thrive better if we provide better inputs in Eastern? Can we have more production of maize in the Rift through bank credit? So what needs to be done? What models can banks create or financial institutions create? Then the other issue that I found coming out in the paper as an insight was to do with the context. When it comes to the topic, once again, which context are we looking at? But when you read the paper, the context is the Kenyan context. So the topic can be improved to limit the context. Then the other bit is controls. Just in the paper, the presentation has been very good, but we could have terms, because it's a financial economics paper, terms like ceteris paribus, other factors being constant. Then still in the paper, much as the variables are clear, average temperature, average precipitation, there could be direction, increase, decrease, leading to. However, in the presentation, it's been already cleared, so it could be incorporated in the paper. So basically, that's my observation. I thank KBA for giving me this opportunity and the others for coming up with such a paper. Thank you.
Thank you for the opportunity to be part of these pertinent discussions, especially at this time where climate change has become a very, very key and important item, especially when it comes to matters that are close to our heart, matters touching on food security, and also just the livelihoods of the bulk of the people in Kenya. So thank you so much for the study, and thank you all for taking part in this. So looking at the paper, I do acknowledge the fact that the paper is quite comprehensive. It has looked at the importance of agriculture in this economy, and as Lucy mentioned, I do not intend to repeat what she said. It's looked at some of the problems or the challenges that we are facing in this economy and what farmers are experiencing when it comes to cereal production. It's also acknowledged the fact that climate change is indeed important, and there are certain things that are currently happening to kind of boost productivity, in as much as we are seeing agriculture and cereal production being a big contributor to Kenya's economy. It has been on a declining trend. The paper also acknowledges the fact that through providing financial resources, the financial sector can help farmers adopt practices and technologies that mitigate the impact of climate change. However, I think it's also important for us to acknowledge the fact that the relationship between agricultural credit or credit to cereal production and the environmental impact is not that straightforward. We've seen the paper quote that there are some studies that suggest that even as we increase credit to the agricultural sector or to cereal production, we are still seeing negative impacts as a result of that. For instance, higher carbon emissions. and that's basically due to intensified farming practices. So I think it's important that even as we extend credit as banks, credit should be directed towards sustainable business practices. And I think there's a lack of knowledge gap when it comes to that, because something that we can improve on is to say, is the paper looking at large-scale farmers, or is it looking at subsistence farmers who are really relying on cereal production for farm to fork as their day-to-day source of livelihood? It will be important to distinguish that. We've also realized that if you look at the paper, it talks a lot about enabling access to credit, but there's a lot that banks are doing to support cereal production and also the agricultural sector as a whole. And the paper has not mentioned that. And we've seen that banks support also climate mitigation in the agricultural sector through various ways. The first one will be by enabling access to credit. But there's also other certain aspects that we do as a bank that should have been considered in the paper. For example, how do we support even the least of the farmers to enable access to credit? And items to do with partnerships with other development organizations to offer concessional funding, and also just instituting capacity building so that we are able to help the farmers understand some of the new technologies that have come into play, understand some of the key infrastructures that they will need for them to institute to help them become bankable and to help them be able to access credit. There are certain solutions that we are also looking at, things to do with de-risking solutions. And for example, banks have guarantees and they partner with other players to help de-risk the market and help the farmers access credit, such that if there's any losses that have been incurred, then those losses have already been guaranteed and covered, and banks are actually doing that. If you look at some of the barriers to credit, the paper has not mentioned that. What are the barriers that are making the farmers or cereal production not be able to access credit? And I think it will be important for us to mention some of those challenges. And then also, what are some of the things that influence banks' appetite towards lending to agriculture? We've seen a lot of non-performing loans in that sector. And the paper really does not dive into how can we ensure that we are also capacitating and we are looking at some of the risks that banks are looking at in order for them to be able to even extend that credit to the farmers. Again, what is the potential effect of government policies or subsidies? For example, subsidies to do with fertilizer, subsidies to do with inputs into the farming inputs and things like that. It will be important to also mention that as part of the discussion. Overall, I do think that credit is important, and credit will indeed help farmers mitigate the impact of climate change. And we do understand that through credit, then farmers, as Lucy mentioned, farmers are able to access climate-smart technologies and practices. There are certain things that also banks can play in, things to do with risk management, offering solutions or financial products like weather index insurance goes a long way in supporting climate variability and helping farmers manage the risks associated with that. Looking at sustainable practices and the type of technology applied, Promulgation of crops that are more drought resistant. It should be a requisite for due diligence to assess whether the farmers are applying appropriate agricultural practices. And I think we need to also call experts, technical experts, to come into play to help banks provide expert opinions to enable also and to enable banks support farmers more effectively. There's a lot of money that is being pumped into research and development. And we know that funding can support research into new crop varieties and farming methods that are more resilient to climate change. For banks, we look at aspects such as diversification of operations, which is an important factor that farmers and even the agricultural sector need to be educated on. The business models that they are employing in their farms. Do they have access to greenhouse facilities or open farming? But we do appreciate that the former is a more controlled measure than the latter. So banks are really increasingly helping solve for this crisis by really fostering education and capacity building to farmers. And I think that's an important point that should be considered. Looking at also the type of infrastructure and technology applied. Credit can be used to develop the infrastructures. For example, things to do with storage facilities to help farmers reduce their post-harvest and water harvesting systems. So indeed, there's a lot under play. There's a lot that banks are doing that has not necessarily been mentioned in the paper and which would be beneficial if we were to include that. On the hindsight, it's also important to mention that what are these barriers that are really diving down into the barriers that are really limiting farmers and access to credit to the agricultural sector and cereal production. Something very important to highlight as well. Overall, looking at some of the policies in place in the country that not only support climate smart agriculture or not only support the agricultural sector and cereal production to thrive, these interventions need to also come into play for us to be able to tackle the effects of climate change. In short, it's not just about credit, but it's also all these other interventions that count, and all of us have a part to play, both from the farmer's side, to the bank side, and to the policy makers. Thank you.
Thank you, our discussants, for giving us such enriching comments. Actually, the reason for having this meeting here or discussion here is for us to receive comments to improve the paper. And from our end, I think it's important for us to take time to look through the comments and see how best we can improve. So I'll not be standing here to defend any of the comments. But just a little bit on that. The comments on trying to look at what else the banks are doing, I think that's an important comment which we'll take seriously. Besides just the credit, there's a lot that banks are doing in terms of capacity building and things alongside that. And also the component of what other sectors are doing, especially the government, the supporting sectors like Met Department, research is also key. We will try to see how to enrich it. To touch on one comment, why cereal production and narrowing down to specific products. Actually, if you read the paper, we have really tried to disaggregate the cereals. We have around 6 cereals, key cereals, and this was informed by the role of agriculture sector in the economy. You cannot say that agriculture sector is not key or agriculture sector is risky, because if you break down the GDP, you'll realize that Well, the sector contributes around 22% to the economy. But the other sectors are more of like, agriculture is like the backbone. It has the forward and backward linkages. If you break down the services sector, look at hotel and accommodation, tourism, all these depend on agriculture sector. If you look at industry, the food industry, if you don't produce wheat, where will the industries in the wheat sector get the produce from? So this actually informed us looking at these key cereal that we produce, given that they are staple and they account a lot, especially in the food basket. So the paper has tried to disaggregate. Maybe I would request KBA to share. And as we had envisioned it, we were focusing more on credit to these sectors because that is where data allows. If you break down the credit by crop, you'll realize that we have these big sectors like horticulture, tea, which are more of cash crop, and most of these are large scale, and they could be having other alternative sources of credit other than the banks. So this is the reason why we focused on these very key food crops that touch mainly on the small scale farmers and also partly on the large scale farmers. Thank you.